Presiden Amerika Serikat Donald Trump berencana untuk segera memilih ketua Federal Reserve The Fed berikutnya. Dia bahkan mengatakan telah mengidentifikasi pilihannya untuk menggantikan ketua saat ini, Jerome Powell. Lebih lanjut, Trump mengungkapkan rasa frustasinya untuk segera mencopot Powell dari posisi ketua The Fed saat ini. Saya rasa saya sudah tahu pilihan saya. Saya ingin sekali mengeluarkan orang yang saat ini ada di sana, tetapi orang-orang menghalangi saya, kata Trump, tanpa mengungkapkan siapa pilihannya kepada para wartawan di Ruang Oval. Selasa 18 November 2025. Dilansir dari Investing, Menteri Keuangan Amerika Serikat Besen, yang memimpin proses pencarian ketua The Fed yang baru, telah mempersempit kandidat menjadi Gubernur Fed Christopher Waller dan Michelle Bowman, mantan Gubernur Fed Kevin Warsh, Direktur Dewan Ekonomi Nasional Gedung Putih Kevin Warsh, dan Eksekutif BlackRock Inc. Rick Reader. Kami memiliki beberapa nama yang mengejutkan, dan kami memiliki beberapa nama standar yang dibicarakan semua orang, dan kami mungkin akan memilih cara standar. Senang rasanya sesekali bersikap politis yang benar, kata Trump. Besen berencana untuk memberikan rekomendasi resmi kepada Trump setelah liburan Thanksgiving. Presiden telah secara terbuka memuji berbagai kandidat, tetapi belum menunjukkan preferensi yang jelas terhadap individu tertentu. Penunjukan Trump akan menggantikan Powell yang telah berulang kali dikritik oleh Presiden karena terlalu lambat menurunkan suku bunga. Masa jabatan Powell sebagai ketua berakhir pada Mei 2026. Meskipun masa jabatannya sebagai Gubernur The Fed berlanjut hingga 2028. Trump menegaskan kembali minatnya agar Besen mengambil alih posisi The Fed, tetapi dia menyebut bahwa Menteri Keuangan AS tersebut lebih memilih untuk tetap memegang perannya saat ini.
As president, there are a few decisions more important than nominating leaders of integrity and good judgment to hold trusted positions in public office. And few of those trusted positions are more important than the chairman of the Federal Reserve. Accordingly, it is my pleasure and my honor to announce my nomination of Jerome Powell to be the next chairman of the Federal Reserve. Congratulations, Jay.
Thank you, Mr. President. Thank you very much, Mr. President, for the faith that you have shown in me through this nomination. And I'm both honored and humbled by this opportunity to serve our great country. If I am confirmed by the Senate, I will do everything within my power to achieve our congressionally assigned goals of stable prices and maximum employment.
Thank you, everybody. Thank you very much.
Thanks.
Thank you.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. When I appeared at this podium 1 year ago, the economy was at an inflection point. Our policy rate had stood at 5.25% to 5.5% for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand and supply. Inflation had moved much closer to our objective, and the labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Indeed, labor force growth has slowed considerably this year with the sharp fall-off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.